Question 3, they are telling us we show how Zurich should account for the employee defined benefit scheme in its financial statements for the year ended 31st December 2022. So without wasting time, of course, here we are going to start answering the question. Remember, this is IAS 19. When they say you show how Zurich should account, you don't need to just immediately start answering. You need to give the background. You need to give the background of the standard. When they say show how Zurich should account for the employee defined benefit scheme in the financial statements, we need to know what should appear in profit or loss, what should appear in our balance sheet. And in case you have any other item that appear in the cash flow statement, also you put it, you tell the examiner that this item must appear in the what? In the cash flow statement. It all depends on the question you are handling. So here, what we are going to do, let's see, write something.
Okay.
This is question 3. So we are going to say that defined benefit schemes create both assets and liabilities. Okay, that is number 1. Our defined benefit scheme create both assets and liabilities. Then you're going to say that IAS 19, that is employee benefit, requires an entity to measure the plan assets at fair value, and defined benefit obligation at a present value. At present value. So it's something you needed to know. When we say that defined benefit scheme create both assets and liabilities, what are these assets? It's because these assets are called plan assets. But these plan assets, the standard requires us to measure these assets at fair value. Then with liabilities, of course, these liabilities are called defined benefit obligation. Those are your liabilities. Okay. So from this one, you're also going to say that the standard, you can also write something and say that the standard requires plan assets and defined benefit obligation to be remeasured at each reporting date, and recognize the gains or losses on remeasurement in OCI. So when you remeasure, let's say plan asset or defined benefit obligation, when you get a gain or a loss, that gain or a loss on remeasurement should be recorded, should be recognized in your OCI. That is
other comprehensive income.
That is other comprehensive income. Okay, let me hope we are together on this. Then, once you state this, then
Yeah,
you're going to say,
a minute,
okay, yes,
Abe. I'm
yes,
just saying are you saying the losses are going to be reduced in the OCI,
yes,
or
where
I
you
put
have
them in the
OCI,
expense?
you'll find that where you have OCI, after profit or loss, where you have OCI,
Yes.
you can put loss on remeasurement. Then you also put loss on remeasurement. Then also, if you have a gain, you put gain on remeasurement time. You indicate both. If it's a loss, you put a figure in a bracket, like 2 million. If it's a gain, that figure must be a positive. That is under OCI. Remember, after OCI,
Okay.
what you get, are you in a position to hear me? After
I'm
OCI,
hearing you very well.
After OCI, what you get is total comprehensive income. How do you get total comprehensive income? You will get what you have. It could be, let's say, profit for the year or loss for the year. Then you add what you have under OCI. The total you will get is total comprehensive income. Is it clear?
Yeah, it's clear. It's clear.
Okay. So after writing something like this is just like a background, especially if question is on, if it is question 2 number, you don't need to just start answering. If it is a question 1 number, you just get what should be indicated in the balance sheet or in the profit or loss without talking much about standard. Okay, but a question 2 number, you need to write something. Okay, so here we are going to say, therefore, when you put therefore, it means that now you're switching from the theory to calculation. Therefore, our company, what is the name of the company? What is the name of the company?
Check.
Therefore, let me see. Question 3. Therefore, Zur. Therefore, Zur. Therefore, Zur. Therefore, Zur. Zur should account. Zur should account for the employee, benefit scheme as below. Remember, for purposes of not giving yourself hard burden, you just work on it separately. You look at plan asset separate, also look at defined benefit obligation separate. So it means that here you will do. Now in an exam, anyway, it's okay. In an exam, you may leave a space, or you do your workings here, then at the end you give conclusion. But you see, for presentation marks, sometimes it's good to leave a space here, then you do appendix. Okay, but here I'm just going to do everything here. We are going to put here the first one. I'm going to start with remeasurement of plan asset. We do this working. Here you are going to put details. You're going to put details. After these workings, I will tell you what should appear in PL, what should appear in other comprehensive income, what should appear in the balance sheet. But let's do this working, okay? So measurement of plan assets. What do we normally start with? You start with the fair value of plan asset at the start of the year. That is balance brought down. You go to your question and see what is the balance brought down. They are telling us that the present value of defined benefit obligation, this one you will handle it separate. So let's look at the fair value of plan asset. We have started with asset at the start of the year, that is 1st January 2022. This is our amount. We start with this
1.2.
1.2. Then you add you add the return, expected return. Of course, this money is already in the account. It is earning some money. Okay, so here expected return. Are we given the cost of capital in the question?
8%.
It must be given 8%, the discount rate. If they don't clearly say that it is a discount rate, they will give you the treasury bill rate, the interest on government securities. It's what you use. But you must be careful. You must know what is at the start, what is at the end. Here we normally focus on the rate at the start of the year. So this is 8%. So we are going to get our 8%. 8%, then we multiply by 1.2 million. What do you get? 8%.
So I can also put interest on. I'm just saying the wording. Because you have expected return, I can use interest.
Now, where we use
add interest.
It's okay. It's okay. It's okay.
Interest
because
income or something.
This is like interest income. This is like interest income. Then when you are handling defined, when you are handling defined benefit obligation, this will be interest cost. This is like interest income. Then when you are handling defined benefit obligation, that will be interest cost. Because an obligation, you have an obligation to pay. It means that if you have not paid, there is an interest that you must pay. Please note that this is like interest income. This is like interest income. Okay, next, we are going to add contribution. At least understand this format. Contribution to the scheme. Contribution to the scheme. Contribution. Do you have contribution to the scheme? If you're not given contribution to the scheme, don't bother. That one will be 0. That one, contribution to the scheme, will increase what you have there. Then next now you raise. Now you raise what? You raise benefits paid out. Benefits paid out. This one will appear when you're handling asset and also when you're handling liability. Take note, and it will be the same amount. So this is how much? Negative what?
250.
250. And I want also to clarify on contribution. If you realize that the contribution was made on first at the start of the year, that contribution will also earn an interest income. If this contribution was made at the start of the year, it must also generate some income. Okay, so that's something you must recall. You will put a fair value of brand asset, you put contribution at the start, then when you're getting expected return, you get 8% times the fair value at the start, then plus the contribution at the start, so that you can get the overall expected income. So it's something that you must note. Yeah? Next is what? Okay. Next is URES. URES, what we call settlements. It could be gain or loss. Okay, here you can say loss or gain. On settlements, on transfers, on curtailments. Remember, I talked about those words, and they are many. So you may be having a loss on settlement, you may be having gain on settlement, depending on the question. Okay. But here for you to record it, let me just put settlements. Settlements, it could be settlements or transfers or cartels. What do we have? Do we have settlements in the question? Do we have cartels? We don't have. So there it's 0. We don't have. So this one is 0. Now in an exam, you don't need to show this. If it is not there, you don't need it to show. Anyway, you may put 0 like this. It's also no problem. Okay. Maybe you are wasting here just a minute, yeah, or a second. Okay. So that's all, colleagues. At least master this. Master this. From here, what you will get is called, the total will be called expected fair value of plan assets carried down. If you add, what do you get? If you add, what do you get? Remember, if a figure is negative, you must make sure that that figure is subtracted. So this is expected fair value of plan asset. However, you are going to compare, but actual fair value of plan assets at the end of the year is how much? This one must be given in the question. It's how much? The fair value of plan asset at the end of the year is 1.4. So you also record that. This is 1.4. So compare this expected value with actual to see whether you have a gain or a loss. Remember, this is an asset. So the question is, do you have a gain on remeasurement or a loss on remeasurement? This is what you expect as your assets, but this is actual. It's
supposed to be a gain.
So you expected this, but now your assets, an increase in an asset, that is a gain. Increase in liability, that is not a gain. It's a loss. So here you have a gain on remeasurement. A gain on remeasurement. The balance, the difference. So that again is how much?
26.
26. So you also now, you handle the liability part. So you can also say remeasurement of defined benefit obligation. Some steps. Same steps. But remember, we said that at the start, our defined benefit obligations are measured at present value. So you're not going to use fair value. So you're going to say that present value of defined benefit obligation at the start brought down is how much from our question? Is 1.3, isn't it? We are given the present value of defined benefit obligation at the start, that is 1.3. That is 1.3. Then we add what? We add interest cost. This is a cost. It's you to pay. So it is 8% times 1.3. Okay. So what do you get? 8% times 1.3. That's what
104,000.
Next, I add. Now, after handling your interest costs, you're going to add current costs. These are costs paid to employees during the year. Current service cost. Service costs. This is what the company paid during the year. It would be salaries, mention all of them. Bonuses.
400,000.
This is 400,000. Then do we have past costs? Add past costs. Past costs, past service costs. Do we have them in the question?
No, no.
We don't have past service costs. If they are there, you must add. So here it's 0. Then next, you are going to now less the benefits paid. As I said, benefits paid appear on both sides. Assets and liabilities, the same amount of money, but there must be a negative, okay? That is what? Negative
250.
Okay, then next, we less.
Transfers.
We could be having also here transfers. Or curtailments, like that. But here we don't have. You may be having a liability and you transfer that liability to another person, maybe that to an insurance company. So when you see such kind of statements, you should know. You should know. So here we don't have. So from here you can get the total expected present value of defined benefit obligation. You can even abbreviate, it is okay.
1.6. Summation. Okay.
That's what you have?
No.
How?
Yeah, yes, that one. Yes, that one.
Then you compare, but actual present value of defined benefit obligation is how much from the question?
1.6.
1.6. Then finally, do you have a gain or a loss? You compare.
It's a loss.
Here we have the liability has increased. You expected the liability to be 1.5, but you see actual is 1.6. So ideally the liability has increased, and an increase in the liability, that's a loss. So this is a loss on remeasurement. Loss on remeasurement. The difference. Okay, so from here, you can report now. You can report and tell us what will go to, tell the examiner what will go to profit or loss, what will go to OCI, what will go to the statement of financial position. So you can use extracts because here you're showing. So you can say extract of profit or loss and other comprehensive income for the year ended 31st December 2022. And let's keep our 1,000. Remember, when you're handling profit or loss, you start with incomes. From incomes, we don't have interest income. If at all, wait. Now, I want you first to observe this. I want you first observe this because it might happen. You are going to compare. You see where you have expected return, this one. Then also with interest costs. Always first compare and see whether you have a net income or net loss. Okay, it could be net income or net cost. So compare the income with the cost. Which one is higher? The cost
The expense is higher. The cost.
So you will have net interest cost. The difference, net interest cost. If you realize that the expected return is higher than the interest cost, then you will have net interest income. And net interest income is part of other incomes. So you have like other incomes, you put in net interest income. But here we don't have other incomes. We just have expenses. Expenses. Expenses, so you can start with net interest costs. The difference, please show the examiner that you're getting the difference between 104,000 and you're subtracting 96. What do you get? That is it 400? 400. Ah, wait, no. This one minus okay, we get 8,000. Then we look at other costs. Other costs are what? Other costs that must appear in our PL are current costs and past costs. Current costs, we have current costs. Current costs. That is how much? Current costs, 400. Then we don't have past costs, so you don't need it to indicate. But if it is there, you put past service cost, past service costs. Here it's 0. I believe those are the items that appear in our PL. Those are the only items that appear in our PL. Then we go to OCI. What are items that you must put under OCI? You can leave like a space, then you put OCI. Because these are extracts. OCI, what are you going to put? You're going to put now. Do you have a gain? Yes, you have a gain. Remeasurement, you can say remeasurement gain on the plan asset. And that is how much? It's 26. Then you're going to put, you have remeasurement loss on defined benefit obligation. That one you must put it as a negative 46. Then if at all you want to sum up, you can get the total comprehensive charge by adding all these. But here you are showing. So this is just an extract. That's enough. You have shown the examiner that our net interest costs will appear under expenses. You will also put current costs, put service costs. But here you don't need it to indicate because we don't have. So under OCI, you put that. So you have shown what should appear in our PL and also under OCI. What about balance sheet? what will appear in the balance sheet. So you can have extract of statement of financial position. That 31st December 2022. What will appear? Okay. Here you can put your amounts in UGX 1,000. Okay. So what will appear? As I said, what you will bring here, you just bring assets and liabilities. So it means that what will appear, you have actuals. Remember what appears in profit or in a balance sheet are your actuals. So you'll put actual fair value of plan assets at the end of the year. That is carried down. Then you also bring actual present value of defined benefit obligation at the end of the year. Then what you will get will be the difference. Do you have now, when it is like in real practice, we don't do this. You just capture the net. But here, since this is an extract, you can show. What was our actual fair value of plan asset? This is the fair value. Then what is the present value of the liability? The actual. $1.6. So do you have a net asset or a net liability? If it's a liability, put a negative. Do you have a net asset or a net liability? If you compare these two.
Liability. Net liability.
So you can have net scheme liability. The difference. And that's all, colleagues. That's all. That's really all with that number. You have shown what should appear in the profit or loss, what should appear in the balance sheet. So we are done with that number. This number, this part normally appear in question 1. Because they can put this as a note. Let's say note 8. They put all this information, note 8. Remember, if you're consolidating, if it is, let's say, consolidated statement of financial position, you should know after all your working what should appear in the balance sheet. If it is a consolidated statement of profit or loss and other comprehensive income, now from your working, you should know what should appear in that consolidated profit or loss. So it's from your working. After doing your working, you will be capturing, if it is a consolidated profit or loss and other comprehensive income, you will know that under expenses, these ones must appear. You must add these ones. Maybe you could find that these ones are added under admin. You could put them under admin depending on the examiner's direction. Okay, if examiner is not specific, you can put these ones under admin. Or you can put these ones under finance costs, okay? But in your mind, you should know that from my working, I will have this one that must appear. Also, if you have loss on remeasurement or gain on remeasurement, don't forget that after handling profit for the year, we look at other income, other comprehensive income, then you will have to add these ones. So this one can appear in what? In question 1. Like as you see your reference, if you check December 2021, you will find it there. If you check this August 2019, you will find it there. So I humbly request you visit after today's session, you visit these papers, December 2021 and August 2019. Now with question 5, when you look at the required part, they are telling you as a financial consultant of MOVE, prepare a paper suitable for presentation at the next EXCO, Executive Committee meeting, that includes 1, discussion of the key differences between a defined contribution scheme and defined benefit scheme with specific reference to the MORU's schemes. That is Roman 1. This is theory. Then Roman 2, you also in your paper, you include the accounting treatment of the above schemes in MORU's financial statements in reference to the accounting standards. The standard here you're talking about is IAS 19. So let's write something here before. Of course, here, what are we given before we write? Of course, here we want to know what is the difference between defined contribution scheme and defined benefit scheme. But since they have said with reference to the MORU schemes, let me first see the schemes that MORU has. MORU operates in the garment sector in Uganda. MORU would like advice on how to treat certain items under IAS 19 employee benefits. The company operates 2 employee schemes, namely premium benefit scheme and standard benefit. So we have 2 schemes. Oh, okay. We have 2 schemes. My laptop is zero. That is happening. Do we have Arsenal fans here? The following information relates to schemes. Now, scheme 1, premium benefit scheme. The scheme requires employees to make monthly contribution. Remember, now you want to differentiate what is the difference between these 2 schemes. Okay, here they are telling you this premium benefit scheme requires the employees, workers, to make monthly contribution of 4% of their basic salaries, which are deducted at source. Then for each employee, the company MORU makes monthly contribution equivalent to 11% of each of the employee monthly basic salary to the scheme. However, in addition to monthly contributions, MORU guarantees employees, this is very key. MORU guarantees employees benefits upon retirement or termination. If this company terminates your contract, or maybe at the end of your contract, maybe it is the retirement age and you have decided to retire, MORU guarantees that you will be entitled to these benefits. So what comes into your mind, colleagues? Who has a risk here to run this scheme? The risk is on the company. MORU has an obligation. So what kind of this scheme? Is it a plan asset? It's
a defined benefits scheme.
it a defined benefit scheme? So it's something that you must know from this statement. Remember, if let's say we are workers, and of course we know that sometimes we have these schemes at workplaces. Company will say, okay, we know that for us as a company, we run this. You as workers, you're supposed to, sometimes they say you keep saving 10% or 5% or 1% of your salary. Then when you're leaving, we will give you this money. But also the boss or the company says that, okay, when you're leaving, we'll give you some rewards. This scheme we are opening, every employee, I will be contributing this. You contribute 1%, I contribute 10%, or I contribute 5%. Okay. The reason why the boss is contributing is to make sure that at the end, there is money available. There is money available. Otherwise, when that boss is not contributing, the money may not be available by that time. Okay, to give you the rewards, or to offer you the rewards. So here we have confirmed that here the company has an obligation to pay in the future. Okay, so let's look at the standard benefits scheme. The scheme requires employees to make monthly contribution of 5%. You employees, workers of the basic salary, which are deducted at source. Before paying, they deduct this. For each employee, more makes monthly contribution equivalent to 10% of the employees, 10% of each of the employee monthly the scheme. However, more obligation, more does not determination of the employees, and the entity's liability is limited to the monthly contribution to the scheme. So what does this one mean? What does this one mean to you? It's like NSSF.
Yes, defined contribution scheme.
So this is a defined contribution scheme. It's like NSSF. NSSF. You the employee, your boss, your company may just contribute, but they have no obligation. They cannot guarantee you that what they are contributing to NSSF you will get. No, there is no obligation with that. That scheme is run by the external, the NSSF fund. Okay. So here you can now start answering. You can now start answering because now you know you can differentiate. Now you know that this is a defined benefit obligation. Then this one is the contribution scheme. But let's write something. Let's write something. Question 5. This is a good number for section B. Remember, we are writing a paper. We are writing a paper. What is the format? The format of the paper is like that one of report. Two. We are writing 2. We are addressing this paper 2. As a financial consultant, prepare a paper suitable for the presentation at the next. Okay. Moore is in the process of finalizing its and the company CFO has approached you. Okay. So I'm going to say to chief finance officer. of more. From who? From you. Since they have specified, you're going to say from financial consultant. If they have not specified, you say CPA student. Then date, exam date. Today is which date? 16th. Our exam date is, okay, let me put exam date is imposed when? 19th May.
19th.
Oh, you guys, you are not going to do 19th May 2025. Subject. Subject, you can summarize, just try to summarize. Try to summarize. Subject, what should we put? You can say simply just and simply put employee.
Benefit schemes.
Employee benefit. Part A and part B, you can bring them in introduction. You can say that I submit this paper in what? In fulfillment.
Fulfillment.
In fulfillment of my engagement terms as who? As a financial
consultant.
Of more. Continuation. The paper, now you say the paper includes what and what. The paper provides, the paper provides on what? On the, Now you bring what they have indicated, Roman 1 and Roman 2. On the, you can say the paper provides the guidance on the difference between a defined plus all that. Then you also bring the accounting treatment. Let me see how I can summarize. The paper provides guidance on the nature and the key differences between a defined contribution and the defined benefit schemes. And the accounting treatment, isn't it? That is Roman 2. And the accounting treatment, of morals, employee benefit scheme. Okay, so you start. Now you start. You can start with, but it is good to start with theory. Now you start talking about, I can talk about the defined contribution scheme, and I can also talk about the defined benefit scheme. Defined contribution. What do you know about this? In a defined, I think we are not going to do the other standard. In a defined contribution, scheme, what happens? The employer and the employees make defined periodic contributions into the scheme. which are invested, and the size of the scheme, and the size of the scheme at the end, and the size of the benefits, that is post-employment at the end, post-employment benefits paid to the former employees depends on how well the scheme's investments have performed. Because when you're contributing this money, it doesn't mean that the money will just remain on the account. You have to invest that money. And at the end, of course, you're going to receive like NSSF. You contribute every month. That money is not just on the NSSF account. NSSF will have to go ahead and invest that money on your behalf. And that's why like last year, I think some of you received an interest. The money, the interest was good, around 11 point what, something there. It was a good interest. So it all depends on how the investments have performed. Okay. Okay. Are we together here, colleagues? Have you understood this statement?
Yeah, it's clear.
So that is all about defined contribution scheme. Look at it as if it is like the scheme, or look at it as if it is NSSF side, NSSF fund. Okay. So we are also
Abel.
Yes.
Okay, I'm just wondering, do you need to add on other things like
Yes.
under this
Yes. Now, because
scheme,
this was a number taking around the 15 marks.
If we don't need to put too much English.
Okay, so in an exam, it's you see how to you can write one statement, but let me put for now, at least this is a discussion. In an exam, you see how to compress, isn't it? But let me just try to how to explain this. Then we can also write and say if the investments perform well, the scheme will be able to afford or to give higher benefits than, because here you're explaining to someone who doesn't know what is defined contribution scheme. So you try to at least bring in different things. If the investments perform well, the scheme will be able to afford higher benefits than if they don't perform well. That's what you can also bring. Tell that CFO. Then now you switch for Moore's case. For Moore's case, now we want for Moore's case, we want to tell which scheme is defined the contribution scheme. for Muru's case, what is defined contribution scheme? From our explanation, it means that for Mur, the standard benefits scheme is a defined contribution scheme in which Muru's liability, because here Muru's liability stop on what? The Muru's liability is limited to only the monthly, contributions, scheme. So you have told the CFO what is all about this, what is all about defined contribution, and you have clearly shown what qualifies as the defined contribution scheme in relation to Moore. We have said that this standard benefit scheme is defined contribution scheme. So that's enough about defined contribution scheme. Also talk about the defined. Now you talk about the defined. Now let's talk about the defined benefit, the defined benefit scheme. Let's try to finish up. I want to watch this again. So defined benefit scheme. Let's write something, and we say that in defined benefit scheme, the employer and employee make periodic contribution. Here we are not saying defined, because with NSSF colleagues, it is defined. You must contribute a certain percentage. It is defined. But here, it all depends on the agreement. You and the company. It's not all that like fixed. It all depends on what? On the company agreement. So in defined benefit scheme, the employer and the employee make periodic contribution into the scheme, which are invested. Of course, here they must be invested. The size of the size of the post-employment benefits is determined in advance. This is different from this. Here, as you enter into this scheme, you define what will be the benefits at the end. But this one, it all depends on how the investments have performed. So what does this one mean? Okay, let me also write this. The size of the contributions. The size of the contributions is set at an amount is expected. The positive employment benefits. So since we are saying that here, the size of the post-employment benefits is determined in advance, it means that the size of the contribution must be set in line with what you expect as the future post-employment benefits. As you set that amount to contribute by each, you, the employer and the employee, you must also be knowing what will be the future benefit. It can help you to set the what? It can help you to set the price. Okay, so we are going to say that if, however, it becomes that the assets in the scheme are insufficient, what will happen? What if at the end we realize that there is no money? What will happen? The employer will be required because this is run by the employer, so he will be required to make additional contributions into the scheme in order to offset the expected shortfall. You realize that at the end you might not be having enough money to pay, then you must add some money in the fund. Okay, let me hope we are together. In an exam, you write what you can recall. But let's now try to write. Let's try to write everything. However, if the scheme's assets perform well, better than expected, and excess of what is required, the post-employment benefits. The employer may be allowed a contribution of them. It's something that you must know. Remember here, you the employee and the employer, all of you are contributing to this scheme. But what if we realize that the scheme is performing well? And you see that already you have met you have met the threshold, then you are the standard allows you actually, the standard allows you to have a holiday. Because it's you to pay at the end and you see that already the scheme has enough for you to pay. So you don't need to keep contributing you as the employee. So it's something that you must know. Then finally we switch for Moore's case. For Moore's case, what is defined benefit scheme? For Moore's case, the premium benefits, scheme is a defined benefit scheme in which Moore's liability, in which Moore's guarantees post-employment benefits. With the defined contribution, you don't guarantee, but here you guarantee. Okay, and that's all. So from here, at least you can even know the difference. So key differences. Just to know that here, the key difference lies in who bears the risk. That's where the difference is. Key difference. Just to know that the key difference between the two schemes lie in who bears the risk. Only that. Okay, so we are going to say that if the employer bears a risk by guaranteeing post-employee benefits, then the scheme becomes a defined benefits scheme. However, where the investment risk is borne by the employee, then the scheme, the investment risk colleagues here, who has invested money? NSSF has invested your money. So who bear the risk? It's you, the investor, not NSSF actually, you the investor. Because if the investment has not performed well, it's your money that is going to be affected. It's your money that is going to affect it. So here we are saying, however, where the investment risk is borne by the employee, then the scheme in which, sorry. Then the scheme is defined contribution scheme. That's the key difference. Maybe if you want to add something, you may say that in a defined contribution scheme, the liability of the employer is limited to the employees, is limited to the employer's contribution. Employer's contribution to the scheme. While in a defined benefits scheme, the employer has an obligation to make additional contributions into the scheme. What does this one mean? If employer is contributing on your behalf that NSS of contribution, he has no obligation to add any other money. But with defined benefit scheme, he has an obligation to add additional contribution in a situation where he realizes that the money in the scheme is not enough. He or she will add more money, not like NSSF contribution. So that is also something to note. So you need to make additional contribution into the scheme if there is unexpected shortfall in investments. So I think those are enough points. And I believe from now you have understood the difference between the two. I know when we started on this standard, I believe it was something it was looking to be hard, but I believe now at least you know what to do. Now, the accounting treatment, I will just talk about one, because other things I will only talk about how do we account for defined contribution scheme. Because what we are doing here, colleagues, this one, remeasurement of plan asset, remeasurement of defined benefit obligation. What we are doing here actually is related to a benefit scheme, defined benefit scheme. Okay, so if it is defined benefit contribution, accounting treatment. This is the last part for now. How are you going to account for the standard benefits scheme? How are you going to account this? Remember, we have said that this is a defined contribution, scheme, but for which MOVE does not need recognize or liabilities. Colleagues, you note the difference. Kindly, you note the difference. With the defined contribution scheme, you don't recognize any asset or liability. But with the defined benefit scheme, you recognize assets and liabilities. Now, if you don't recognize assets and liabilities, it means that what are you recognizing? If it is a defined contribution scheme, it means that the contributions all the contributions you're going to be making will be expenses. The contributions paid by move, that is of how much? Of shillings. Let me see in the question, do we have the amount? Because you must be having those with standard benefits scheme. This is the contributions by Moore and contributions by employees. So the contributions by Moore of shillings is this one. The contributions by Moore of shillings, 345 million, will be charged or recognized in profit, charged to profit or loss account as an expense, not an asset, as an expense. While the contributions, while the contributions by the employee is recognized as part of salaries and wages cost, which is also recognized in the profit or loss account. Okay, I believe this makes sense.
Yes.
And that's all, colleagues. And that's always, that's how you're going to account. Just to know that all contributions, if it is defined contribution scheme, you will not be having any asset, you will not be having any liability, you will not be having anything related to remeasurement. All those things are going to come under defined benefit scheme. So you will handle premium, you will handle the accounting treatment for premium as your assignment. But it's the same thing we have done from our first two questions. So you just say this is a defined, this is a defined scheme, this is a defined benefits scheme that requires, of course, you can say maybe detailed accounting in the books of as below. Then you start as below. Or you may bring this thing that we talked about here. These ones. But here, all you need remeasurement on the defined obligation. Please, you are going to do the measurement of defined obligation. That is like defined benefit obligation. Then you also need remeasurement, the measurement of asset, defined asset from in assets. Then from that, you will draw the extracts of balance sheet and the comprehensive income. I believe you will handle. Because you have everything. From
Yeah.
here, it's like, this is like question 1, that the question 3, you have everything like this. You have everything. If it's a obligation, you know what you add. Remember now, interest, the interest cost will be on obligation, and the interest rate you're going to use. You see that here you have 1st January and also 31st December. So you will be using 10%, the one at the start. But really, this is like what we have handled. This is like question 3. This is like question 3. You just follow, and that will be all.